Howdy there, folks. Got to talk about selling everything, getting out of this market, the wall of worry, all those sorts of things in this video here today. I want to discuss a bunch and put it all into one video. First thing I want to do is actually react to this video. I'm on Recession Watch. This came out a few hours ago, and I thought it was quite interesting.
Fast after that red-hot inflation report, the 10-year yield breaching 2% for the first time in more than 2 years. Then came word that St. Louis Fed President Jim Bullard is in favor of a more aggressive rate hike path, which pushed markets down another leg. Let's get some perspective on both bonds, rates, and stocks. We're joined now by our friends, Sri Kumar, president of Sri Kumar Global Strategies, and Ryan Dietrich. He is chief market strategist at LP.
By the way, market's just about to close here. NASDAQ's down over 2.6%, so it got a lot worse since this video came out.
Financial research. Sri, it's great to have you back on. Let's talk about what something Steve Leisman just hit on. In your mind, how much of future rate hikes are built into the markets, both stocks and bonds, right now?
The reason somebody asks a question like that is essentially so you can understand, like, if there's more rate hikes in the market, maybe the market sells off a bunch because that, let's say the market's only expecting, and I think it's even bad to say this amount of rate hikes, because the thing is the Fed can raise more than 0.25% each time, right? Everybody thinks a quarter point is what the Fed's going to raise each time. They could easily do a half a point each time as well. So I think it's almost silly. I think it should always be like, well, what percentage do you think we're at the end of the year?
Brian, great to be back with you. I will begin by saying there is no saying how much the interest rates are going to increase. I would say to you it could be 4, 6, 8 times from where we are. And the reason is the Fed.
That might be the new record. Now this gentleman's saying 8 times for Fed increases. Holy smokers,
it has been so far behind the curve in missing the inflation that they have to make up for it. So my expectation is whether they raise 25 basis points or 50 basis points on March 16th, it is not going to be sufficient. I would ask the question, with inflation being red hot, what prevented the Fed yesterday from having an emergency meeting, stopping bond purchases? By the way, bonds are still being bought this month. The money supply is being increased. They are buying mortgage-backed securities, pushing up home prices as President Biden is worried about home prices being out of reach. This is a Federal Reserve which is not in touch with reality, Brian. So it's hard to say. But the most important point, I would say, is the bottom line. A few minutes ago, you had the screen showing the 2 to 10 yield curve, and that narrowed to 40 basis points last night. As recently as last Friday, it was 60 basis points. We are heading toward inversion in a hurry. I think I am on recession watch, which I have been for the last 6 months, but now it becomes more urgent.
Wow. Ryan.
See, that's the thing with the Fed, right? You talk about, oh, you're on recession watch, but then if the Fed's going to raise rates, a lot of folks feel there's a high probability of a recession or a major recession if the Fed raises rates a bunch. So the Fed, yes, they've been lagging on this whole situation. I think we all know this. They should have been already raising rates. However, that's the past. The past is the past. And so the question is, moving forward, what's the best course of action in a situation like this?
In just 1 second, I've got to follow up with Sri on that, because some of the smartest people I talk to, like yourself, Sri, and others, will kind of liken what's going on now to, and I won't quote who said this to me, they said, the Fed is like the arsonist now trying to put out the house that they lit on fire. Money.
I like that. I like that. I will say I do like that.
Is up 40%. QE is still going on. Rates got cut to a level that we now know they did not need to be cut at. Does the Fed have the ability to put out this fire? I mean, you could make the argument that inflation is caused by two things. The
problem is the whole house is engulfed now in the flames. And it's like, okay, if the whole house is engulfed, is it a little too late?
Reopening at the same time, we know that. But also our Fed, and to be fair, other central banks all raising their balance sheets, cutting rates because, and I guess I'll give them a break on this, Sri, they fundamentally underestimated what was going to happen during the pandemic, not realizing that consumer demand would go up, not down.
Very true. I love your analogy, Brian. Let me begin by saying that not only do I like it, the Fed is trying to put out the fire with gasoline. So that is essentially what is happening. So the fire is going to burn even brighter and bigger. What is going to happen? The second part of your question, can the Fed control it? No. They cannot control it without pushing the economy into a recession. Yeah. If they raise rates even 3 or 4 times, forget about 6 or 7 times, Brian, the economy is going to go into a recession just as...
All right, so let me push back a little bit there, okay? This gentleman says if the Fed raises rates even 3 or 4 times, it's going to push the economy into a recession, okay? I think that's being a little aggressive. Like, everybody thinks the only way you can have a good economy is by the Fed having interest rates near zero, and that's just not accurate. We can have a healthy economy and have rates at 2, 3, 4%. Now, if you're talking about 10%, that's a whole different discussion, right? It might be harder to have a good economy in that situation, but we've raised rates. Just a few years ago, we were raising rates and we were in a rate hike cycle, okay? And the overall economy stayed fine. So I think we give the Fed a little too much credit, and we think like the only way we can have a good economy is if the Fed's pumping money out there and as if interest rates are at zero or near zero. And I just don't think that's accurate. I think we can have 2%, 3% Fed funds rate, and I think we can have a normal economy and a good economy. So I think just people get way too caught up into the, oh my gosh, it's the Fed has to be the superhero, and if it's not the Fed, then we're done. We're finished. We're going to have high unemployment. We're going to have a disaster of economy, and I just don't see it like that at all, to be honest. The U.S. economy can be strong and can have rates at 2, 3, 4%.
President Biden and Democrats are going into the midterm elections.
Ryan, there's nobody out there that's got more historical context than you. I lift your stuff all the time, by the way, for the RBI, so thank you on that. This is a market that's facing a multi-headed hydra. I mean, you've got inflation. You've got the risk of a Fed mistake. You've got housing, which may or may not slow down. You've got geopolitics, Russia, China, etc. I guess maybe, do we find some comfort in the fact that, the Dow's only down, 3% this year? Stocks have held up relatively well. What do you see happening going forward?
Good morning, Brian. And I liked your dad joke earlier. I don't know if everybody did, but I thought that was pretty good. But you're right. I mean, stocks are up this week. OK, since the low a couple Mondays ago. Yes, we're kind of consolidating. I know everyone's worried about yesterday's reaction to 2-year yields. Big deal. But, S&P went up to the 50-day moving average and sold off. Small caps went up to that bottom of the range they were in and kind of sold off. So it kind of makes sense. I mean, look at the Economist cover, Brian, that just came out this week. It's talking about what to do after the market crash. I mean, sentiment is extremely lopsided and very worried. We just mentioned a lot of concerns that are out there. But you know what? The consumer is still really strong. Yes, like Chipotle, they upped their prices 4%. People are still buying the burritos, right? I mean, eventually there's a breaking point with that. But consumers strong, and earnings are coming over 30% year over year. Those are some real positives still, Brian. So we're a little more optimistic, I think, here that we're still in a bull market, we think, and the economy is still strong, and we're going to avoid a recession this year because the consumer is so strong, in our opinion.
Interesting. Okay, no one watches Shepard Smith. Come on, man. So I want to share something here I got for you guys. But let me just finish off my thoughts on that whole video there. I think this is why there's always this this underbelly of end the Fed and things like that, because people believe they are so in control of everything. And they believe they're what controls basically, creating stock market bubbles or creating real estate bubbles or creating overall economic bubbles, whatever it is, right? And then they're looked at as if they raise rates, they're going to cause the entire economy to go into recession, which causes high unemployment, which causes job losses, which causes people to become dependent upon the government to get through that time until they get jobs again and until the Fed essentially says, oh, we're going to pump money in the economy again, okay? And so This is what is so frustrating to a lot of folks out there, and I think that's where the whole "and the Fed" thing really comes from, is this overall frustration that the Fed holds all the power and they dictate whether we're going to have a recession or not a recession, or whether we're going to have a bubble or not a bubble, and all these sorts of things, right? And so the Fed is absolutely a force to be reckoned with, and they're absolutely very, very powerful. I just don't think, there's a thought process out there from a lot of folks, and I've heard this, that if the Fed raises rates, we're going to recession. If the Fed raises rate, that means the stock market's going to crash or go down in a significant manner, right? And I just don't see it like that, to be quite honest. I think overall, what it really comes down to at the end of the day is, are businesses hiring? Do people have good jobs? And usually is inflation at a acceptable level? We always know there's going to be inflation out there, but is it at an acceptable level? Right now, it's not an acceptable level, right? Now, in terms of the Fed, pumping money out there and things like that, buying bonds, they should have already been pulling back a while ago. They should have already been raising rates, but that's, looking in hindsight now, right? And so when I look at this from my perspective, I think we can definitely have a 2 or 3% Fed funds rate and have an overall decent economy in the United States of America. It doesn't have to be booming, but we can have an acceptable economy with low unemployment. It's, I think this, it's frustrating for me to kind of listen to folks, and they think like literally the only way we can have anything positive in the stock market and the real estate market and anything is that the Fed has rates at zero or near zero. And it's like, it doesn't really work like that. Okay. So but I can understand the concept of kind of thinking that way though, because, a lot of people have gotten into this ultra belief in the Fed and that they are the superhero or the villain, and they're constantly one of those two things. Okay. Now, next thing I want to talk about here, selling everything. I even saw a few comments, from folks in the last video, like, oh man, I'm just going to get out of this market. There's too much going on right now, right? You have, one is the Fed. What's the Fed going to do? How many times are they raising rates? How much are they going to raise rates each time? There's that whole worry. It's like they want to be cast as a superhero and they want to be cast as a villain all at the same time. It's pretty remarkable, actually. Okay. You have obviously the Russia situation and what's going to happen with Russia and Ukraine, which is a huge worry right now for the markets. And that's kind of causing overall global instability, I would call it. And that's causing us into a situation where, oil could be affected, natural gas could be affected, pricing on those could be affected, right? And Russia might not mind if prices go up for all those things, right? They cause a lot of worries. Prices go up. I could probably do a whole dedicated video to that if I want it, right? You have the inflation worries, which inflation still is coming in worse than anticipated. CPI, it's really CPI, right? CPI came in above what everybody was anticipating. And a lot of those numbers were just complete BS. I mean, if you really look at those numbers, like the rent number, come on, man. Every other publication you look at that's tracking what rents have been going up, they all have them skyrocketing. And then in this situation, the CPI shows the rent, barely up. It's like, give me a break, right? A lot of those numbers were just complete BS in my opinion. And a lot of people's opinion, I always know my dad said, don't believe any of the numbers that the government puts out. And I can understand why he says that. When I look at these numbers, I'm like, come on, man. So inflation's going crazy, right? We have that going on. We have a worker shortage in this country. I mean, just about any job out there has workers. I don't care if you're talking about truck drivers. I don't care if you're talking about, service workers of any kind. I don't care if you're talking about restaurant workers or fast food. We have a worker shortage in this country in mass right now. And you go pretty much anywhere and they're hiring. So we have a worker shortage. That's not getting solved anytime soon, by the way. You have Amazon and Meta report weak guidance. You have supply chains are still messy, although I will say we've heard on several conference calls now that supply chain is getting a little better. So that one is starting to flip. That's at least some good news, okay? You have no stimulus in 22, and you have companies that are probably going to have low amount of buybacks because of the wall of worry, right? And so what this is like the Great Wall of China of worry in front of us, right? And it's built brick by brick, and we are just looking at this massive, and by the way, there's more than this. I just wanted to cover the big stuff, right? There's even more than this. And so we have this massive wall of worry, and people are saying, hey, I'm thinking about just selling everything, get out of this market because there's too much going on. There's this insane, overwhelming amount of stuff we have to deal with. And what happens if Russia invades Ukraine? And what happens if the Fed raises rates to, the Fed funds rate to 2% by this time next year or 3% by this time next year, right? And inflation's going crazy. And so you have everybody kind of, thinking man, maybe I'll just cash out and dip out of this market and things like that, right? Well, first thing to understand is when you're in a wall of worry, it's something that holds back the market, and that's what's holding back the market right now, right? And we know the Russell got hit the worst out of everything, but the market, can't go up right now. And the reason the market can't go up, even though companies, if you listen to what's going on with companies, okay, almost all the big companies have already reported earnings. We just got small cap season still going on, okay? Every single big company out there that I pretty much track is expecting revenue to be up, and up quite nicely in 22 versus what they had in 21. Almost every company I track is expecting net income to be better, EPS to be better in 22 than in 21, okay? But with that being said, we're in this situation where people are still scared despite all these companies telling you that their revenues are likely going to be up in 22 and their net income is going to likely be up in 22, right? And so that's causing this wall of worry. That's causing this market to not be able to go up because there's all these external things to worry about. What's Russia going to do? What's the Fed going to do? What's inflation? Is it ever going to start coming down? Now, keep in mind, that big wall of worry I gave you right now, which is one of the biggest wall of worries I've seen since I've been in the market, and we always go through these time periods, essentially, okay? Remember, all these things are very short-term in nature things, right? The Russia-Ukraine thing, whether they invade or don't invade, that's a short-term thing, right? Inflation, what happens when inflation ticks the other way? When does that happen? First off, it could be in a month from now, it could be 3 months from now, 6 months from now, 12 months from now. One thing I know 100% for sure is inflation will start ticking down, and it's just a matter of question of like what month does it start ticking down. So that's a short-term thing. Worker shortage, that's not going to fix itself outside of a massive global recession where, jobs were lost, and so there were more free workers, right? The Amazon and Meta week guidance, those companies are just amazing. And so don't be surprised if those flip from kind of having weak guidance for quarters and things like that to all of a sudden the back half of the year flipping to positive, much more bullish numbers, okay? The supply chain mess is already starting to get fixed. And we've heard this from company after company saying basically things are getting a little better, okay? The no stimulus, that's not going to fix itself. Buybacks are low, but guess what? As soon as there's a little more visibility and we get away from this wall of worry, guess what? Companies are going to start buying back their shares left and right. And so when you start to look at the big wall of worry in front of us, you start to realize all this stuff is pretty much shorter term stuff that's going to, and you're going to find that consistently with the markets. Whenever we get into a wall of worry, it's all stuff that's ended up being short term. Even if we go back to what happened in 2020 with Rona, right, a once in 100-year pandemic coming out of nowhere to slap us, even that was a short-term thing, right? And so all these things are more short-term in nature, and so you got to focus on kind of like, are you making a short-term decision to try to get out of the market and then get back in? Those are tough. Those are really, really tough things to do. And it's like, when do you get back in? And the thing is, when you're in this wall of worry, you got to understand the more insanely high the wall of worry gets, the more unrealistic it becomes for that wall of worry to get worse and worse and worse. And eventually what happens is the wall of worry starts to get torn down and the bricks start falling and everything starts deteriorating. And next thing you know, you can see out there and there's no wall anymore, right? And then eventually the wall starts getting built up again and then you got a big wall of worry again, okay? But what I can tell you is this big of a wall of worry is not normal, and the good news is when it comes to this is eventually these bricks are going to start falling, and then everything's going to go away, and then the sun's going to come out, and then guess what? The market's going to make some pretty epic moves, and there's going to be some stocks that make some insane moves up as soon as the wall of worry starts to get destroyed brick by brick by brick, okay? And so that's why I just continue to stay focused on the long term, not trying to time this stuff out and be like, oh man, the Russia situation, what's going to happen here? Let me get out. The Fed, got to get out. At the end of the day, for me, I stay invested. If there's great deals in stocks I love over the coming years, I buy those stocks and I call it a day essentially. And all this other stuff, I pay attention to and I watch it and it's entertaining. But as far as it affects the markets in the short term and it causes stocks to go down, it causes stocks to not go up. But at the end of the day, the sun comes out again, and next thing you know, the market prospers, the Russell prospers, small caps prosper, mid caps prosper, and then large caps will prosper again, okay? And we're in this cycle right now where, a lot of the large are kind of getting hit harder. And you see the Russell actually on many days recently is starting to outperform to the upside and actually doing better on the downside than the other indexes, which is quite interesting kind of tell in the market right now that we have going on. Hope you guys enjoyed this video. As always, let me know what you're doing out there in the the market, make sure to subscribe to the channel if you're not already. We got the massive Valentine's Day sale going for the private stock group, Financial Fortress, right now. You want to check that out while that deal's going on before it ends. Check out pinned comment down there, and maybe get some free stocks from Mumu as well. I'll have that as pinned comment also. Much love and have a great day.